Hello everyone, myself Jostan Souza from first BCom. I am here to briefly explain the concept of money in a nutshell. Now, what is money? The word money comes from a Roman word called moneta. This is the name of a Roman goddess, Juno Moneta, in whose temple money was minted. Money is anything that is used to buy or sell goods and services. It is one of the greatest inventions of man. It also enables indirect exchange of goods and services. Let me define you the term money. According to Alfred Marshall, money includes all those things which serve as a means of purchasing commodities and services. According to D.H. Robertson, money is anything that is widely accepted in payment for goods or in discharge of other kinds of business obligations. According to Milton Friedman, money is temporary abode for purchasing power. Now, let us see what are the functions of money. There are basically three major functions: the primary function, the secondary, and the contingent function of money. Now let us move on to the first function, that is the primary function. The primary function includes the medium of exchange and the measure of value. The medium of exchange. In earlier days, the barter system was in practice, and goods itself were given in exchange of particular good. As you all know, money is generally accepted source of buying and selling of goods and services. It possesses the purchasing power through which cash transactions can be done. To tell you about the measure of value, under the barter system, there was no common measure of value. For example, a horse may be valued for 5 cows or 5 quintals of wheat or so on. Money has brought great change in the physical unit of measurement like meters, liters, kilograms, etc. This has helped the suppliers and the purchasers of the good to make decisions about how much good to supply and to purchase. To move on to the secondary function, it includes the standard of deferred payments, the store of value, the transfer of value. The standard of deferred payments. It is a function of being widely accepted way to value a debt, thereby allowing goods and services to be acquired now and paid in the future. To tell you about the store of value, while barter system was in use, it was not possible to store, but money has helped to store and to use it in the future. The transfer of value. It is very easy to transfer the money, say for example from Mangalore to any part of the world, using the modern system of banking like bank draft, NEFTs and so on. To move on to the contingent function, it includes the distribution of national income, basis of credit, maximization of satisfaction. Distribution of national income. Money helps to distribute the national wealth to each and every citizen of the country. It is not possible for a single person to produce outputs. Instead, it takes the efforts of many people like workers, landowners, investors and so on. To tell you about the basis of credit. Credit plays a very important role in the economy of the country. People deposit their money in the banks, hence the credit is created. Maximization of satisfaction. A consumer maximizes his satisfaction by terming each and every product in the term of money. Even producers plan for his profit by quoting each and every product through price. This is in short the functions of money. Now, let us move on to some of its classifications. The term money means the indirect exchange of goods and services. It has evolved over centuries and has changed its form over a period of time. The earliest animal money to the latest electronic form of money can be classified under various categories, such as based on money material, based on legality, based on liquidity. Let us move on to the classification made on the basis of money material. First one, the animal money, such as cows, goats and so on, served as the money in the ancient days. Second one, the commodity or the article money. According to the history, commodities or objects were used as money in ancient society. For example, bows, arrows, tea, sugar, and so on. The third one, the metallic money. The difficulties of commodity money gave rise to the metallic money. Countries started to produce money using gold, silver, bronze in the form of small coins. Fourth one, the paper money. Money made of paper is known as paper money. The central government of our country produces paper money to the reserve banks. Fifth one, the plastic money. 21st century gave rise to the various types of plastic money, say for example credit cards, debit cards, through which we can withdraw money 24/7. Sixth one, electronic money. It refers to the virtual banking or e-banking. It is also called as e-cash. On the basis of legality, the money is divided into the first one, the legal tender money. It is the money that is put into circulation by the government. It is the obligation of the people to use it as sources of payment. The second one, the non-legal tender money. Money that is accepted by people has no legal protection by the government. It includes bills of exchange, checks, promissory notes, and so on. The classification made on the basis of liquidity. The first one, actual money. Money which is in circulation is called actual money. Coins and notes are the example to this type of money. Second one, the optional money. It refers to the various liquid assets which are not cash but can be easily converted into cash, like government securities, bank deposits are the example for this. Now let us know what is near money. It refers to highly liquid asset that can be rapidly converted into cash, such as short-term money market instruments and bank deposits. It means non-cash assets that are very liquid but cannot be used directly for transactions. Let us understand the types of near money. First one, the drafts and the bills of exchange. It is a type of financial instrument with which is attached a promissory note to pay the amount in specific time in future. The second one, treasury bill. When the government wants to borrow the funds, it borrows to treasury bills. It has to be paid in a specific time period. Third one, the bonds. They are written form of loans. They are also called as debentures. It is a long-term liability for issuing firms or the institutions. Fourth one, the equity shares. In order to run the business, the firm should sell their shares. Shareholders are the owners of the company. They take part in the profit and loss of the company. Fifth one, fixed and saving deposits. People deposit their money in bank accounts through fixed or saving account. Such amount can be withdrawn at any point of time. Sixth one, savings certificate. The certificates which are issued by non-banking companies are called as savings certificates. They give higher rate of interest than that of banks. Let us now understand the demand and supply of money. Demand of money increases during the boom period or when the trade is very high. It decreases during the depression or when trade is in risk. When the demand for money increases, there are various benefits for the country, and when the demand decreases, it means that there is economic slowdown. The demand for money is inversely related to the interest rate. At high interest rate, people prefer to hold bonds. When interest rates fall, holding bonds gives a lower return, so people prefer to hold cash. When the interest rate is more, the demand for the money increases. When the interest rate is less, the demand for money decreases. Here you can see in the diagram, R1 is the interest rate And when R1 is high, the quantity of money increases. When R2 is the interest rate, the quantity of money decreases. The supply of money refers to the stock concept and not the flow concept. It means that the total of all the forms of money which are held by the community at a certain point of time. When the demand curve D1 cuts the supply curve at S1, the rate of interest is determined. The graph describes us that when the quantity of money demanded is equal to the quantity of money supplied, then the equilibrium takes place. So finally friends, money has brought radical change in our society. It is so important that we cannot even imagine ourselves without money. Money isn't everything, but everything needs money. Thank you.